Welcome back, everyone. I hope you guys are having a fantastic week. Today, we're going to talk about bridge loans, also known as hard money.
Yes.
What is it, Galen?
Okay, so what are they? These are very expensive short-term loans, usually just to bridge a gap and just to solve a situation, temporary situation for a borrower.
Definitely temporary, right? Because there has to be an exit strategy for this. Remember, you have to have at least 50% equity position when you're going to be borrowing hard money, right? And not only that, the interest rate's going to be high from 10 to 12 to 10 to 12 to 13%. So if you, some hard money guys I've seen is, they've missed a payment and it jumps up to 18%. Look, I'm not going to say hard money is completely out of the question and it's not a good opportunity for someone to do. It is sometimes, right? But it depends on the situation, because if you're going to borrow the money to refinance down the road, or you're going to borrow the money to sell the fix the property and sell the property, then okay, it makes sense, right? You know, already you're struggling making one payment and you're going to borrow this hard money, right?
Yeah, it's not going to make sense.
Yes, sometimes it's good. Most of the times it's not.
Yeah, so why would a property owner want to do something like this?
Well, look, let's just say it was me. Let's say I'm in the situation that I need to borrow a hard money loan, right? My only situation would be that I have an exit plan, a short-term exit plan.
Yes, because they're only like 12 months.
Yes, and not only that, because I know I'm going to be paying interest only, right? I'm going to be paying interest only. I'm paying points up front.
They're expensive.
I'm eating up my equity. Like if you get this thing for 2 years, imagine how much equity you've eaten up, right? Depending on how much you borrow and what that interest rate is.
Yeah, so important that they must have an exit strategy planned out.
100%.
It's got to make sense. Because you don't want to get yourself into another hard money type of loan, another Band-Aid.
And
right?
we've seen it. And look, at the end of the day, Galen, the hard money lenders are very difficult to negotiate with when you're in foreclosure. So if you miss some payments, they're going to be calling the loan, and they're going to call the entire loan sometimes, and they're very difficult to deal with.
Yes.
Most cases.
They then maybe acquire the property back. Sometimes, however, hard money can be a good thing, right? They serve their purpose. The borrower obtains the funds. They fix the property. Maybe they get a large windfall of funds, and then they get back into shape with their payments. But you got to be very, very careful when getting into some of these loans and understand why you're doing it and how you're going to exit out. So there is a qualification criteria.
Let me just get one thing real quick, Gillian, before we move on. Here's one thing, guys. Sometimes the individual is going to get some money in 3 to 4 to 5 months, right? And they're going to be able to pay that hard money off back, right? That's another good opportunity, right? If you're going to get some money in the near future, then go ahead and borrow the hard money, right? But if not, remember, it's a short-term loan.
So the qualification criteria, what is it?
Wow, let's get into the qualification criteria, right? I think we said it just a few minutes ago. You must have at least 50% equity on that property.
Yes. Yeah, typically in the conventional, say for a conventional loan, you're based on credit and income and so forth. But for hard money, you don't necessarily have to have any of that. No credit score. It's based simply on the asset.
Yes, simply on the asset.
Yeah.
And if you have enough equity position in that property, then you're good to go, right?
So along with that, so the process is you apply for the loan.
That's number one. You got to apply for the loan, right?
Yep. You got to submit your documentation. You got to go through the loan approval and their terms. You then receive the funds, which again takes typically about 7 days to go through this process. That's one good thing about these hard money loans is you can obtain them fairly quickly.
Yep.
So then there's, of course, the repayment part of it as well. So just preparing that, you must understand that you have the ability to repay this back, and that's what they're also going to look at.
And you can get these loans and they close in 7 to 5, sometimes 10 days. Like it's quick, right? But the consequences, you have to be very careful with the consequences, right?
So there's some pros and cons we'll go over there with you guys. Of course, the pros is that it's very quick. You don't have to go through, fewer credit requirements.
Yep.
And so it solves the issue, just like Louis just mentioned. You can bridge that gap and get past this very challenging moment in your life and get into the next phase.
Exit. There has to be an exit, right?
Yes.
So cool.
The cons is that the hard money loans are usually higher interest rates and have a lot of fees from the traditional ones.
Yep.
So then it's about making sure, these borrowers are digging a hole into the situation.
100%.
They're eating at their equity.
Yes.
So once again, they're very costly, very expensive,
Mhm.
and these are short terms, things to keep in mind.
Yes, and very difficult
Yes.
to negotiate
Yes,
with, right?
because the inevitable is that they must come to terms that they're going to have to sell the property. They cannot keep this, this loan forever.
Yes, look, guys, at the end of the day, you've worked very hard for your equity. You've put a lot of hard work in creating that equity. Protect it. All right, guys.
Thank you, guys.
Welcome back. Let's go.